Alright folks, welcome to video 3 of our 4-part video series on how to equip property managers to better understand the property investing process. And in this video, Hayley and I are going to break down finance and tax. Now Hayley, I always say to folks that property investing can easily be thought of to be about bricks and mortar, but I reckon property investing is more a game of finance than it is a game of bricks and mortar.
Absolutely, it's all about numbers.
All about the numbers. So folks, we're going to introduce to you some key concepts that we hope we're going to break down to be super simple so that you understand and have better conversations with your landlord clients. Now the first one we want to talk about, Hayley, is the difference between principal and interest and interest only. So let's have a look at that. When you have a principal and interest loan, typically it looks like this. You start off with a loan amount here, let's call it, I don't know, let's just call it $500,000. And then over the journey, you are looking to pay that loan off in its entirety. Versus interest only loan, which is pretty much you start at $500,000 and it keeps going, and you don't necessarily pay it off. Now the bank's going to come to you after 5 years and they're going to say, hey listen, we've given you interest only for 5 years. We now want to see you start paying off the loan. But what most investors do is they either reset it for another 5 years at interest only, or in some cases they change lenders. Now Hayley, why is it that this one sounds pretty good? You get a loan and you eventually pay it off. Why would an investor not want to pay off the loan? Why would they want to keep it the same?
Well, number one, because you pay less, so you're not paying as much money, and any interest that you pay is obviously tax deductible as well.
Tax deductible. So what we're saying there is the premium that you're paying monthly would be, let's just call it X, whereas the premium that you're paying monthly here might be, I don't know, 2/3 of X. So essentially what Hayley's saying is the monthly commitment at interest only is less because you're not trying to pay off this component. So first of all, it helps with cash flow. But the second thing it helps with is the fact that when you do, this one here is the principal and interest loan, by nature of the term, you're actually paying off some of the principal. And what your accountant needs to do is with that repayment that they're making, they need to work out which part of the repayment goes towards paying off the principal and which part of the payment is going towards the interest. And only the interest component is tax deductible, right? The principal component is not tax deductible. Whereas over here, the entire amount is only going towards interest. Therefore, the entire payment is tax deductible.
Yep.
And why is that important? Because it helps you with your cash flow.
Correct.
It helps you get more tax refund back. So, folks, number one, we want to help you understand fundamentally the difference between principal and interest only. Now, most property investors go for this option. Not all of them, but most property investors go for this. So, concept number one. The next concept we want to talk about is leverage. And why would someone consider getting into leverage? So, let's explain what that looks like. Let's assume you have $100,000 to invest. And without leverage, which is basically using other people's money, getting a loan, you could go and buy something for $100,000. Now the problem is, can you buy a house for $100,000?
No.
You can't.
Well,
although,
no.
if you go back in history when you bought your first one, maybe, but not now. No. So $100,000. So what leverage means is we could use that $100,000 as a deposit, say a 20% deposit, to go and buy a $500,000 property. Because what would happen is the bank would let us borrow up to 80% of the value, which equals $400,000. So they'd lend us $400,000. We combine the money that the bank will lend us with the money that we've got in the bank of $100,000 to combine. So we put that there, put the two together, and all of a sudden we've got enough money to settle on the property. Now, folks, stay with me here. I know we're going to pay stamp duty. I know we're going to pay solicitors' costs, all that sort of stuff, which is usually about 6%. But just for the concept only, it's allows us to leverage up and buy another asset. Now, why would we want to do that, Hayley? Why wouldn't we? Because some people don't like debt. Why would we do that? Why would we want to be in control of an asset worth 500 rather than an asset worth 100?
Well, you've got better capital gain and better yield coming in as well.
You get to control a bigger asset, which means you get to control more rental
money.
income that comes in, and ultimately you want to be able to hold as many of these as you can. So leverage is a very, very important concept, and it's something for you to think about as a property manager, because there is I guess sometimes when you think of someone who's got a property investment, you might think they're really rich or they're really wealthy. Well, ultimately they want to be, but in the early accumulation phase, maybe they're not. They're often just servicing the debt. So important concept there. So leverage, super important. All right, next concept we want to cover, and you will be able to help me with this, is the LVR, the loan to valuation ratio. First of all, what is an LVR and why is that important for property investors?
Well, the banks will loan a certain amount of money depending on the asset, but we can talk about LMI now.
Yes.
Yeah, so for example, when I first bought my property in South Yarra that I explained, I think it was video number 1, when I purchased that property I only had a 10% deposit. So let's say your example before, and you know, so instead of having 100,000 I may have only had $50,000 deposit. So what the banks then said was, yeah, we'll lend you the money, but you have to pay mortgage insurance, so that if there's defaults, then obviously that's all covered. So they'll lend you a higher piece of the pie, but you do have to pay mortgage insurance, which gets rolled into the mortgage. So over a period of time, you don't even notice it. But the whole fact is a lot of people don't like the LMI because they're looking at it going, I have to pay more. But my way of looking at it is you get an asset where I wouldn't have been able to get that asset. So I think you made a really good equation before that, I can't remember what you said now, but it's good or bad. Like you've got to look at the asset that you're looking to get. But I think that if you can get into the market with the right asset, LMI is a no-brainer.
No-brainer. So let's recap on a couple of really important things that Hayley just talked about. Number 1, LVR stands for loan to valuation ratio. So on the previous example before, when we bought a property for 500,000 and we had a loan of it 400,000, the loan, i.e. the 400,000, to the value of 500,000, the ratio equals 80%, right? That's all it means. LVR, the lower the LVR, the better, because it means you've got less loan against it. Let's put another example. Let's say I've got a loan of 200,000 instead of 400,000. Well, the loan, the 200,000, towards the value, what's the ratio? That is 40%. If I've got 100,000, it'll be 20%, right? So the loan to valuation ratio. Now what Hayley just said, which is super important, this is a ceiling, 80%. The banks are usually comfortable with 80%. Yep. As soon as you go over 80%, the banks start to get a little bit wobblier because you are moving up the risk scale. So then we introduce this concept that Hayley just talked about, which is called lender's mortgage insurance. Lender's mortgage insurance. And it's basically if you get a loan that exceeds an LVR of 80%, you need to pay lender's mortgage insurance. Now, an important distinction here with lender's mortgage insurance is, who does it actually protect? Does it protect the bank or does it protect you as the lender? And you might be surprised by the answer, because it is the bank that's actually, so you're paying the mortgage insurance so that you protect the bank in the event that if you default on the loan, they're covered. Yep. Interesting, right? You're paying the insurance for them.
Yep.
But one of the reasons that you would consider that is rewind the tape to what Hayley said before. Her first property, she needed to get lender's mortgage insurance in order to be able to buy the property. So sometimes you've got a choice of, hey, look, I don't want to pay lender's mortgage insurance, but the alternative is I don't get in. Or sometimes the alternative is I don't have, I might get a property that's not investment grade, which we talked about in video 2. I might not be able to get an investment grade property because I can't afford it at a loan to valuation 80%. But if I do a loan to value ratio of 90%, then I'm like Hayley, I only have to tip in 10% plus the costs, okay, stamp duty and all those sorts of things, which means that I'll be able to get a better property. So it's an important concept to understand. And how many property managers in the journey do you think would understand not understand, but be exposed to some of these concepts that are really important to the investor, but maybe not so common in
I actually
everyday?
don't think you're exposed to it until you actually go for your first mortgage. And that was reality with me. I didn't know what it was until I bought my first property. And I remember the last property I bought in my super fund, they gave me some options about if I borrow this much, I'll have to pay LVR, but if LMI, sorry, and if I borrow this much, I won't. But then I decided that if I did pay LMI, it would actually put more money back in my super, which enabled me to buy another property quicker. So there's concepts around it that you've just, what we said in the beginning, it comes down to numbers.
This is what we say about lenders' mortgage insurance, because quite often most people go, whoa, I don't want to pay that premium. Protecting the bank, it's not protecting me. But if you think about what Hayley just said, you pay this in order to control a better asset, or in some cases to actually just get into the game. So here's my theory around lenders' mortgage insurance. Avoid it when you can, embrace it when you have to. Avoid it when you can, embrace it when you have to. And therefore, I don't see it as something that I should avoid at all costs. I see it as something that I navigate, because remember, property investing is a game of finance more than it's a game of bricks and mortar. Really, really important. And for a lot of property managers, they might be going, hang on a second, I'm in the bricks and mortar all day, every day. I'm doing all the forms, I'm doing all the routines, I'm doing all the entry inspections, I'm going to, in some cases, VCAT to fight for these bricks and mortar. But no, from the investor's perspective, it's all about finance. Because one of the things that we talked about before is, imagine if you had $100,000 in cash as a deposit. Some people have $100,000 in equity in another property that they could use as substitution instead of finding a cash deposit.
Absolutely.
So super, super important. All right, which comes on to our next point, which is equity release. Equity release. So it sort of flows on to, okay, do I need a cash deposit or not? Let's assume you have another property. Let's say your principal place of residence that you live in. Let's see how my drawing goes here.
Great house.
Thank you.
Wobbly roof.
Yeah, it's a skillion lean-to architecturally designed house.
Yep.
So, but let's put a value on this. Let's say that your principal place of residence is worth $700,000. All right, and let's say you have a mortgage outstanding. Let's make it easy so I can do the maths here. Of $300,000. What that actually means is you've got a value of 700. You've got debt of 300, which means your equity position on this property is $400,000. But you can't get access to all of it, but you can get access to some of it by still holding onto the asset. So let's say we went to the bank. Now there's two parts of lending. One is, do I have enough income? And the other is, do I have enough assets? Let's just talk to the asset side of it for now. All right. So if we've got 400,000, let's put some numbers in here. Now let's go back to our numbers here. The bank will comfortably lend you 80% of the value of your property. So what's 80% of the value of this here? It's 540,000, 560,000. 700 minus 140 is 560,000. So 80% is 560,000. Let's double check my maths to make sure that is right. 140, yes. So the bank will lend you up to 80% of the value of the property. It's 560. But they won't lend you the 300 again twice, because you've already got that. So minus the 300 you already have means that you have $260,000 worth of available equity. Why is that important? Well, in a lot of cases, people don't have to come up with a cash deposit, do they?
Yeah, that's right. Yeah, I've done it before in my properties where I wanted to get into another one, and you're able to actually extract the money out.
See how it's a game of finance, folks? All of a sudden, I've got equity in my home. The bank will lend me, assuming income, right? So some of you will go, okay, I get it. The bank will do their income assessments, but just for the concept here, we're just talking about assets. They will lend us $260,000 as an equity release, which we can go and use. Some people use it for private things. Some people go and get a holiday,
New car,
a jet ski, a
boat.
new car. We're not suggesting that you do that. We're suggesting you go and do it to buy an investment property, because look what happens. If we then go, all right, let's go and buy a $600,000 investment property. Now again, let's I don't have a calculator, so I'm not going to be able to work out 26%. But let's say you need 25%.
About 120.
Yeah, 125-ish. You're going to need. All right. So 600,000. The bank's going to lend us
150. Sorry.
Yes.
150.
I have the same problem doing the maths in my head too.
Yeah.
But remember, come back here. The bank will lend us 80%.
Yeah.
So over here, they're going to say, I will lend you $480,000 because that equals 80%. But that's not enough, because no one's going to let you settle on a property if you only turn up with 480. So that means we need another $120,000. And let's put in stamp duty and costs here, right? So what, 30,000?
Yep, 6%.
30,000, that's where you get to your 150. So we need $150,000 to settle on this property. Well, that's easy. We just go to this equity release here and we write a check. It's as simple as that. We've set up this equity release against our principal place of residence. We've gone and bought another investment property, and we haven't had to come up with $150,000 in cash. Folks, it's as simple as that. Now, why do you need to understand that as a property manager? Because chances are your clients, your landlords, have done some variation of this. They've gone and put their own home at risk in order to buy the investment property that you're managing on their behalf, so that ultimately they've now got a $700,000 asset, a $600,000 asset. You remember video number 1? What's the reason why they've done that? Well, they now control $1.3 million worth of real estate, and in 10 years' time, they hope it's worth $2 million plus. 2 million plus. That's it. That's it. That's the concept. If you get that very, very simple concept, folks, you are already putting yourself in a very small category of property managers who understand how all of this works. So, pretty important concepts to understand, Hayley.
Absolutely, yeah. And the other thing is that they can keep doing it, right? So once the asset builds up again, you can get properties revalued. So over time, they go up in value, you have more equity. It's a continuing circle.
Good point. So imagine in 5 years' time, this house is now worth 900.
Yeah.
And this one's now worth 750. Guess what? We go and do the exercise again, because we go to the bank and we say, we know that you'll comfortably lend us 80% of the value of the properties to purchase. Can we go and buy property number 2? Now the bank might say no. Or let's put another scenario in. Let's say the house that you have didn't grow in value, right? And to the point that Hayley said before about lender's mortgage insurance, you might have to go and buy property number 2 based on a loan to valuation ratio that goes above 80, that moves into the 90. That's when you would now consider using lender's mortgage insurance, because over here, you might have had to have 90% of the value here to be able to buy that investment property. See how it's a game of finance just as much as it's a game of bricks and mortar. Now, some of those concepts you might be going, whew, that was a lot. But all you need to remember is interest only versus principal and interest. Most investors want to go interest only. The next one is leverage. If I have cash, I can only buy something with the cash, versus if I go to the bank and borrow some money, I will be able to buy a larger asset. Then we've talked about the loan to valuation ratio and lender's mortgage insurance. They are very, very important concepts for you to understand as well. So anything else that we need to sort of highlight, Hayley, before we move on to tax?
No, I think that it gives you an idea, but you've got to plan for this stuff. So, if you sit there and go, okay, well, I want to do this now, and in 2 years' time, I want this. One other thing to think about as well with lender mortgage insurance is if you had to sit and save another $50,000 to get up to that 80% mark, for example, how long will that take you, and how much would the market have shifted? Because if we've got a market that is continually increasing, you're always chasing your tail to get enough of a deposit to buy a property. And I know friends that have done that over the years where they want to buy a property, but every time they get to the deposit, they're priced out of market again. So, that lender's mortgage insurance can really help in that instance as well.
Yeah, by nature of the fact that you want to be in these growing markets means that you generally can't save at a pace that keeps you up to date. So there's some important finance concepts. Now I just want to talk to you about some important tax concepts as well. Now the first one we want to talk to is called negative gearing. Now quite often you will hear a lot about negative gearing, and it's something that you will want to understand on behalf of your clients, which is the landlords. I'm going to make this super simple, right? Negative gearing is just super simple. What it means is, say you went and bought that investment property that we talked about previously. All it means is the amount of income that you're receiving is less than the amount of expenses that you're paying. Hence the term negative. Like, there is a difference between what you're getting and what you're paying. And then gearing is all about the discussion we just previously had. Gearing just refers to lending. Yeah. So I'm getting lending in order to be in a negative cash flow position, which kind of begs the question, why would anyone consider doing that? Okay, let's answer that question. Let's assume that the difference here, let's just put a number in. Let's say it's costing you $10,000 per year to hold the property. And let's assume we bought a property for $500,000 and that property is costing us $10,000. In 10 years' time, ideally if you bought the right property in the right location, and let's say it grows by 7%, that'll be worth $1 million. $1 million. So what you'll have done is you'll have created $500,000 worth of net wealth. Your assets would have increased by $500,000 just on that property alone. However, it's cost you $10,000 a year to hold the property. So in the same 10 years, it's cost you $10,000 times 10 years. So it equals $100,000. So 500 minus 100, it means that you are $400,000 better off. That's it. That's why all of your landlords are in the game. Because if they buy an asset today and they hold it for long enough, it'll grow in value, and the costs of holding the property, if they bought the right ones that we talked about in video 2, should be less than the hold. How does that fit into your overall plan on what you're trying to do in your overall portfolio?
Yeah, absolutely. Most of mine are positively geared now.
Let's explain what that means.
But in the beginning they weren't.
Yes.
So often you'll find that they're negatively geared for the first couple of years, but then as that catches up, or you make changes to property, improvements to property, then you can have that positive cash flow.
Important point. So what does positive gearing means? It means that the rent is actually greater than the expenses. That's it. So it's positive, and gearing still means because you've still got some lending against it. All right, so that is essentially the difference between negative gearing, oops, didn't plan to do that, and positive gearing. That's where the rent exceeds the expenses. So important concepts to understand. But now that you understand them, it's not that big a deal, is it? It's pretty straightforward. That's the reason why they do it. That's the reason why they would negative gear, and that's the reason why they're asking you to steward their property on their behalf on that journey so that they can stay long enough. So you can see that the property manager's role is to make this process of waiting for the growth smooth and convenient and fun. So that is why you will see what we're going to talk about in the next video on what property managers can do to help with that process. So we've covered a few things now. What I want to talk to you now about is another concept that investors will be exposed to, and that's the concept of capital gains tax. So what does that mean? Well, first of all, I want to tell you this. If the property investor holds the property forever, it's not a concept that they need to worry about. Capital gains tax is only something that you have to concern yourself with if you plan to sell. So if you plan to hold these properties, I plan to hold them for a long time. I plan to, with certain conditions, let my kids have access to the portfolio once I'm gone. So capital gains tax is only on sale event. But if we use this example here again, Hayley, if we bought the property for 500 and it went to $1 million and we've now created 400,000 in equity, let's assume at that point in time we decide that's pretty good. I actually want to sell. I want to get that money back. Well, what does that actually look like? Well, first of all, I need you to know this. 12 months is really important. Currently, under current legislation, 12 months is really important. Why is that?
Because under 12 months, you pay more.
You pay more.
It's double, isn't it?
It is absolutely double.
Yeah.
If you hold an asset for longer than 12 months, the government will give you a 50% capital gains tax exemption. So what does that mean? For $400,000 we made, the government will say the first $200,000 we will not charge you any tax. That's pretty good. But what if I did, let's say we were lucky enough to buy a property that you bought for 500 and went for $1 million, and that happened in 11 months. Not likely, but let's just assume that it did. And you sold it after 11 months, you would lose that exemption. So it's good for you to know that when you're having conversations with your landlords, because they might need to understand what year they are going to sell the assets in if that applies. So the first 200,000 is capital gains tax free. That's free money. But the remaining $200,000 will then go onto your tax return, and then you will pay tax at your marginal tax rate. Now currently that will put, that amount of capital gain will put you into the highest tax bracket, but in some cases you might not have earned any money that year, and that might be the only money you're earning. You start to see how tax planning comes into play. Let's not make it complex though. All capital gains tax means is the government will take some of what you've earned and put that into the tax revenue system. That's it. One thing I didn't mention over here, Hayley, which is really important, is this loss here doesn't get trapped in the purely against the property that you're buying. What it does, and this is where the Australian taxation system works, say I'm over here and you're a property manager and you're getting paid PAYG. Your employer is paying you a certain amount of money, and at the end of the year you have a tax bill. What negative gearing does is if you're making this loss, you can actually put that loss against your other income. That's really important. And so all of a sudden, the amount of tax that you've been paying as a property manager, your employer's been taking that on a weekly or fortnightly or a monthly basis. At the end of the year, the taxation office will say, well, actually, you've made a loss over here. We'll actually put that against the income that you've earned as a property manager. And by the way, you've actually by doing that, you've actually overpaid on your tax. So therefore, here's your refund that you can have at the end of the year. And of course, you then put that refund towards reducing the amount you might be able to offset some of that loss and further reduce the amount that you've got. So very, very important concepts here.
One thing as well, you don't pay capital gains on your principal residence. So if you own your own property, you sell it, you don't pay capital gains on that. It's only for investment properties.
It is the greatest gift in the entire Australian taxation system, what you just described, not paying any tax on your principal place of residence. Because let's assume you've got a 700,000 residence, great. But if you live in Toorak or Vaucluse and your house is worth 50 million, you still get that exemption. It is the greatest gift the Australian taxation system has. All right, let's bring this home. All right, one more concept we want to talk, two more concepts. One is depreciation, and the second one is land tax. These are two things that you will need to become familiar with when you're having conversations. First of all, what does depreciation mean? Basically, let's say you bought an investment property and you put in a brand new oven.
Mm-hmm.
How much is it going to cost me for a brand new oven?
Depends how good it is. Let's say $1,000.
$1,000. What the government says is you can't immediately expense that $1,000. What we want you to do is, we think it's got an effective life of, 10 years. They might let you depreciate it $100 a year for 10 years. Or they might say it's got an effective life of 5 years, which means you can depreciate it at $200. Basically, what it becomes is a non-cash deduction. And that is put into, remember back here we had, okay, here's the amount of income we've got, here's the amount of expenses we've got. Most of those expenses will be hard costs, interest and insurance, but a small component of it will be soft costs, which is called depreciation. They will add an amount every single year when you're not actually physically forking out the cash. In the first year you paid $1,000, but in the second year you didn't, the third year you didn't, but you're getting these non-cash deductions which go towards your negative gearing benefits. So all you need to know as a property manager is the maximum possible is what your investor wants, and the best way to do that is by using what's called a quantity surveyor. You would have used quantity surveyors a fair bit in your journey.
Absolutely. Yeah. And the quantity surveyor, when they provide the report, with property like the actual house, for example, there's a 40-year depreciation, whereas the items in the property will depreciate at different rates. So, a lot of owners say, oh, my accountant will do this, but they won't. They won't do it to the level of a quantity surveyor. And their reports are about $700. And you will, for example, my South Yarra property, the first year after I renovated, I got $8,500 back through the depreciation. So, that $700 expense, which was tax deductible, I then got $8,500 back on my tax return that year. So pays for itself for the right properties as well.
Unbelievable. Like $8,000 back for $700.
Yep.
Now, we won't get into detail, but there's two components. There's capital component, which is the building, and then there's chattels and fixtures, which usually has a smaller effective life. The quantity surveyor will combine those two to come up with a number that you can then put on your tax return to help with the cash flow.
Yep.
Very important concept. If you don't know if your landlord has a depreciation schedule or not, it's another interesting point that you can have to keep the dialogue, keep the communication going, asking them, do they have that? And if not, can you help them facilitate getting one for them? I promise you, if you help them get a result that, like Hayley just talked about, they will love you for life.
Yep.
Now, the last concept we want to talk about here is land tax, Hayley. Let's kick it off.
So the government has changed the way land tax works. So there's a lot of landlords who have never had to pay land tax, who now have to pay land tax. So it's on the actual land component of your council rates, basically. So if your land's worth, I can't remember what the thresholds are now. It's gone down though to about 100.
Yeah, in each state they vary, but you need to check each state for the land tax thresholds.
So my mum's got a little apartment in South Yarra, never paid land tax. This year it's kicked in because they've dropped the threshold, so she's had to pay. Hers was, I think, $975 for her land tax, but that's money that she's never had to pay in the past. So it is a big talking point with a lot of your landlords now.
100%.
Yep.
So when you pay the land tax, that goes into over here as part of your hard costs for you to be able to hold this investment property. Now, we'll put a little table up on the screen here where you can see the current thresholds across every state in Australia, and they vary in different states. But ultimately, it's another gift that the principal place of residence has.
Correct.
Why is that?
Because you don't pay it on your own home. So land tax is, again, only on investment.
It's not your principal place of residence is the greatest gift the Australian Taxation Office can give us. So what have we covered? Interest only versus principal and interest. We've also covered leverage. We've talked about lenders' mortgage insurance and LVRs. We've talked about equity release. We've talked about the simplicity of negative gearing versus positive gearing. We've also talked about capital gains tax and depreciation, and of course land tax in Australia. So folks, this particular video has gone a little bit longer than the other ones. It's because it's important.
It is
This
really
stuff
important.
is really important for you to understand. So if there's any concepts that you didn't quite catch, maybe rewind and have another little listen to them. If you want to reach out to Hayley or myself with any queries or questions, we'll have our details in the comments below. But property investing is a game of finance just as much as it is a game of bricks and mortar. So hopefully that's introduced you or refreshed or reinforced some of the concepts that are going to make it easier for you to relate to your clients being landlords, because this is the stuff that they're dealing with all day, every day. You are the steward of their property on their behalf. So it kind of makes sense that you really, really want to understand this. So in the next video, our fourth one in this 4-part series, we're going to go into what do investors actually look for in property managers. And Hayley's going to come into her own here because 25 years of experience. She's seen from when she first started to going through the process now. Not only does she have her own property management business, but she trains some of the best property management businesses across the country. So tune in for that, folks, because we'll give you some insights into what property investors look for. So we look forward to that. One more video to go, folks. Hopefully this has been helpful, but remember, property is a game of finance just as much as it's a game of bricks and mortar.